Welcome back to the deep dive. Today, we are staring right into the belly of the beast.
Yeah, that's one way to put it.
We're looking at the invisible machine that essentially dictates whether you have a job, how much that coffee on your desk costs.
And whether the news anchors are smiling or, panicking about a recession.
Exactly.
But, it's hardly invisible.
Oh.
It's perhaps the most measured, debated, and obsessively tracked machine in human history.
Okay, fair point. I'm talking about the economy. But not just the economy in that, vague, hand-waving sense where we complain about gas prices.
Right.
I mean, the nuts and bolts, the math, the specific gears that turn to generate what we call national income. We're doing a deep dive today specifically into national income accounting.
Which is fundamentally the scorecard of a nation.
Yeah.
If you want to know if a country's winning or losing or even just treading water, you have to understand these numbers.
And more than that.
And more importantly, you have to understand how those numbers are cooked.
Exactly. We're going to find out why buying a cup of tea counts as economic growth, but making that same cup of tea at home doesn't. Which, frankly, still blows my mind.
It's a fundamental distinction, and it tells you a lot about what GDP does and does not value.
It does, but before we get into the nitty-gritty of GDP, GNP, and the whole alphabet soup of economics, we have some very important housekeeping for our specific community of listeners.
That's right. This deep dive is presented specifically by the Simplified UPSC by PPP YouTube channel.
We are incredibly grateful to have you here. And look, if you're finding value in this, if these deep dives are helping you crack concepts that used to put you to sleep
Or just confuse you.
we have a humble request. Please subscribe to the Simplified UPSC by PPP channel. It really, really helps keep this content coming.
And for those who are capable, and, only if you're capable, consider supporting the work on Patreon. It keeps the lights on, the research flowing, and, well, the coffee brewing.
It really does. And a massive, heartfelt shout out to all our current supporters. You folks are the real engine behind this whole operation.
We really couldn't do it without you.
Absolutely. Also, don't forget to like this audio or video and leave a comment. We do read them, and they help the algorithm find other learners just like you.
Now, for the serious students out there,
I know you're listening.
we have resources, yes. If you want the notes that accompany this discussion, along with practice previous year questions, or PYQs, they are available for free on the public Telegram channel.
But if you want the VIP treatment,
The full deep dive experience.
I'm talking about access to this entire series of videos at once, organized premium notes, detailed breakdowns, extra PYQs, and even model mains answers.
Then you need to join the private Telegram library.
It's the deep dive treatment for your study materials. To join, just drop a DM on the public Telegram channel and they'll get you sorted out.
Okay, I think that's all the business.
Business concluded. Let's get to the mission. Today, we are decoding Chapter 2 of the Class 12 NCERT Macroeconomics textbook.
A foundational text. It really is. But we're going to peel back the layers to see the logic underneath it all.
We're going to unpack the machinery of the economy, from the circular flow of income to the nuances of real versus nominal GDP. So, let's start at the very beginning. Or rather, let's zoom out.
Good place to start.
I remember in school being genuinely confused about the difference between microeconomics and macroeconomics. I mean, economics is economics, right? It's all just money.
Well, think of it this way. Imagine you're walking through a dense forest.
Okay.
If you start to study a single oak tree, how its roots gather water, how its leaves turn sunlight into energy, how it competes with the bush next to it, that's microeconomics.
The individual unit.
The individual unit. A single firm. A single household. A single consumer making a choice.
Okay, so micro is me deciding whether to buy a pizza or save my money for a new phone.
Precisely. It's about individual optimization. But if you hop in a helicopter and fly over the forest, you stop seeing individual trees.
Right, you just see the canopy.
You see the forest as a whole. You see if the forest is expanding or shrinking. You see if a fire is consuming a large section of it. That is macroeconomics. We're looking at the aggregate.
So macro isn't just micro plus micro plus micro. You can't just add up all the individual decisions.
Not exactly, no. There's a concept that's really important here called the fallacy of composition.
The fallacy of composition.
It means that just because something is true for one individual, it doesn't mean it's true for the whole group. For example, if you stand up at a cricket match, you can see better.
Sure.
But if everyone stands up,
Nobody sees better and everyone is just uncomfortable.
that's a perfect analogy. What's good for one isn't always good for all.
So at macro, we look at things like total employment, not just whether I have a job.
Exactly.
We look at the general price level inflation, not just the price of that pizza.
Correct. And the source material notes a key insight here.
Mm.
In macroeconomics, the output levels of all goods tend to move together. It's all interconnected.
So,
Generally speaking, if the output of food grains rises, you usually see a rise in industrial goods, too. If employment goes up in factories, it often goes up in the service sector simultaneously.
so the economy tends to move as one giant interconnected herd,
A herd is a good way to put it.
which makes sense intuitively. If farmers have a good harvest, they have more money to buy tractors, which helps the factory, and the factory workers then buy more food. It's a cycle.
It is. But when do we start thinking like this? Has macroeconomics always been a distinct field?
I'm guessing not.
Surprisingly, no. As a distinct discipline, it's actually a child of crisis, specifically the Great Depression of 1929,
The big crash.
the big one. Before 1929, the prevailing economic thought, what we now call the classical school, believed in the invisible hand maybe a bit too much.
They thought markets always self-corrected.
Always. Their main argument was if there was unemployment, wages would naturally drop, cheap labor would entice businesses to hire again, and unemployment would just vanish.
So the government should just stay out of the way.
Exactly. They thought the economy was a perfect machine that would fix itself if you just left it alone.
And then 1929 happened. The stock market tanked, banks failed, and unemployment didn't just fix itself, it stayed sky high for years.
It absolutely did. In the U.S., unemployment hit 25%. In some countries, it was as high as 33%. The classical theory it collapsed in the face of reality. The machine was broken.
And someone needed to figure out how to fix it.
That's when John Maynard Keynes stepped onto the stage. His book in 1936, The General Theory of Employment, Interest, and Money, essentially birthed macroeconomics as we know it.
So what was his big idea? What did he argue?
He argued that the state needs to intervene because the market can get stuck in a bad equilibrium.
Stuck.
He showed that sometimes demand just completely dries up and no amount of wage cutting will fix it. You need a jumpstart. You need to look at the whole system, not just the individual parts.
So macroeconomics is really the study of the whole machine, often so we can figure out how to fix it when it breaks.
That's a great summary.
Okay, so to understand the machine, we need to know what it produces. We need to talk about goods.
And this is where things get tricky. It's where a lot of students trip up. We need to classify goods not by what they are physically, but by how they are used economically.
The economic nature of its use.
Right.
The source material uses a tea analogy that I found really helpful.
It's the classic example. Let's look at tea leaves. If you go to the store, you buy a packet of tea leaves, you take it home, and make yourself a cup of tea to drink while reading a book. What is that tea?
That's a final good. I'm the consumer. I drank it. End of story.
Correct. It has crossed the boundary of production. It's done. It won't be sold again. It won't undergo any more active economic transformation.
Okay. But what if a restaurant owner buys that exact same packet of tea leaves?
Right. So he takes it to his restaurant kitchen, he brews it, adds sugar and milk, and sells the cup of tea to a customer for, say, $50.
So in that case?
In that case, the tea leaves are an intermediate good.
An input.
They're an input. They're being used to create a final product, the cup of tea that's sold to the customer. The tea leaves are used up in the production process.
So the packet of tea is physically identical in both scenarios.
Physically identical, but economically they're totally different. And this distinction is crucial for national income accounting because we only want to count the final good.
Why is that so important?
Well, if we counted the restaurant's tea leaves, AD, the cup of tea they sold, we'd be double counting.
Right, because the price of the cup of tea already includes the cost of the leaves. We don't want to count that value twice.
Precisely. You'd be artificially inflating the GDP number. And there's another nuance here regarding this production boundary.
Okay.
If you cook a meal at home for yourself or your family, that's not considered an economic activity in the eyes of GDP.
Even though I'm producing something valuable, or dinner.
Right. But if a chef cooks the exact same meal in a restaurant and sells it, it is an economic activity.
We'll circle back to that when we talk about welfare, because that has huge implications.
It really does.
But first, let's distinguish between two types of final goods: consumption goods and capital goods.
Right. This is about who uses them and for what purpose. Consumption goods are for satisfying a need immediately.
Like food, clothes.
Food, clothes, services like a haircut or recreation, they get used up or enjoyed directly. They don't help produce other things.
And capital goods.
These are the tools of the trade. machines, implements, buildings. They are durable goods. They don't get eaten up in the process immediately. They are used to produce other goods over a long period.
Like the espresso machine in that restaurant we mentioned.
Exactly. The espresso machine is a capital good. The coffee beans are an intermediate good. And the cup of coffee sold to you is the final consumption good.
Okay, that makes it very clear. What about my car? I use it to get to work. Is that a capital good?
That's a good question. Unless you're a taxi driver using it to earn money, no. For a regular household, a car is considered a consumer durable.
A consumer durable.
It lasts a long time, yes, but it's still for your personal consumption, not for producing other goods for sale.
Got it. Okay, that clears it up. Now, we have to talk about two concepts that sound like they're from a physics class. Stocks and flows.
They are borrowed from physics, in a way. It's entirely about time.
Time? How so?
A stock variable is something you measure at a specific point in time. It's like a snapshot. If I ask, how much money is in your bank account right now at 10:02 a.m., that answer is a stock.
It's a static number at a moment in time.
Exactly. And a flow.
That would be over a period of time.
A flow is measured over a period of time, like a video. If I ask, what is your income, you can't just answer with a number. You have to say 50,000 rupees per month or per year. Income is a flow. It has a time dimension.
So wealth is a stock.
What I have accumulated up to now.
Income is a flow.
What I'm earning over time. Correct. Inventory is a stock. How many shirts are on the shelf today?
And sales are a flow. How many shirts did we sell this month?
You got it.
And this brings us to investment. Investment is a flow variable because it's the act of adding to the capital stock over a period, like a year. But there's a catch. Machines wear out.
Depreciation. The silent killer of value.
Indeed. If you have a factory with 10 machines and you buy 2 new ones this year, your gross investment is 2 machines.
That's the total you've added.
But if one of your old machines breaks down and becomes scrap metal,
then your actual net gain is only 1 machine. That is your net investment.
So gross investment minus depreciation equals net investment.
Exactly.
Depreciation is an interesting concept because it's not a cash expense, strictly speaking. I don't write a check to Mr. Depreciation.
No, but it's a very real economic cost.
Yeah.
The official term is consumption of fixed capital. If you don't account for it, you're fooling yourself. You think you're richer than you actually are.
And that money doesn't go to anyone.
It doesn't become anyone's income. It's just value disappearing into thin air due to wear and tear or becoming obsolete.
Okay, we have the building blocks. We have goods, we have stocks and flows. Now let's put them into motion. I want to visualize the economy. The source material talks about the circular flow of income.
This is the heartbeat of the macroeconomy. To understand it, we start with a very simplified model. We're going to strip away the complexities of the real world for a moment.
Okay, I'm ready.
Imagine an island.
I love island analogies.
On this island, there are only 2 groups of people. There's no government, no foreign trade, no banks. Just households and firms.
Simple enough. Households are the people, firms are the businesses.
Right. Now, here is the crucial starting point. Households own all the factors of production.
All of them.
All of them. They own the labor, their bodies, the land, the capital, and the entrepreneurial spirit. Even the firms are ultimately owned by people shareholders who are part of households.
And the firms need those things to make stuff.
Exactly. So picture a circle. Let's look at the bottom half of the circle first. This is what we call the factor market. Households give their services to the firms. They go to work, they rent out their land, they invest their capital.
And firms pay them for it. This is the first flow of money.
Yes. And there are 4 specific rewards for these 4 factors. For any UPSC aspirant, you need to know these by heart.
Let's hear them.
For human labor, the reward is wages, which we can call W.
W for wages.
For capital, the reward is interest, or in.
In for interest.
For entrepreneurship, the reward is profit, or P.
P for profit.
And for fixed natural resources like land, the reward is rent, or R.
Wages, rent, interest, and profit. That's the money flowing from firms to households. So now the households have pockets full of cash.
And what do they do with it?
Yeah.
In our simple model, they spend all of it, they don't save. This creates the top half of the circle, the product market.
Right.
Households give their money to firms.
To buy goods and services.
And in return, firms give goods and services to the households.
And the loop is closed.
The loop is closed. Production creates income in the form of wages, rent, and so on. That income creates demand. because people want to buy stuff.
Demand creates expenditure as they pay for the stuff.
And that expenditure triggers more production. It's a circular causation.
It's like a perpetual motion machine.
In this simplified model, yes, aggregate consumption equals aggregate expenditure equals aggregate income. There is no leakage. Every rupee produced is a rupee earned and a rupee spent.
But of course, in the real world, there are leakages.
Oh, absolutely. In the real world, households save some money. That leaks out of the spending cycle in the banks. They pay taxes. That leaks to the government. They buy imports. That leaks to other countries.
And there are injections too, right?
Exactly. Government spending, investment, exports, they inject money back into the circle. But for understanding the core concept, the closed loop is the best place to start.
This sounds elegant, but we need to measure it. If the flow is circular, theoretically, we could put a meter anywhere on that pipe and get the same number, right?
That's the perfect way to think about it. And that gives us the three methods of calculating national income. This is where the math comes in, but stay with us. It's actually quite logical.
So we can measure the flow at 3 points.
We can measure it at the production stage, the income distribution stage, or the final expenditure stage.
Let's start with method 1, the product method, or as it's also called, the value-added method.
This one focuses on production. How much value are we actually creating in the economy? To explain this, we have to go back to the farm.
The famous farmer and baker example from the NCERT text.
It's perfect for this. So imagine a farmer. He produces wheat worth €100. For the sake of simplicity, let's assume he had zero inputs. He just collected seeds from the wild and worked the land.
So he created hero value from nothing. His output is 100 and his intermediate consumption is 0.
Correct. Now, he sells euro worth of that wheat to a baker.
Okay, so half his wheat is gone.
The baker takes that euro wheat, grinds it as water, bakes it, and turns it into bread. He then sells the bread for 200.
Okay, so if I want to know the total GDP of this tiny economy, my first instinct is to just add the farmer's output, 100, and the baker's output, 200, is the total 300.
That is the trap, a very common trap. If you do that, you get 300. But think about it. That 200 for the bread, it includes the 50 for the wheat.
Ah.
So if you add 100 plus 200, you are counting that 50 euro wheat twice. Once when the farmer grew it, and again when the baker sold it inside the bread.
Yeah, the cardinal sin of economics. Double counting.
It inflates the numbers and gives you a completely false picture of the economy. So we use the value-added method. We ask, what did each person add to the pot?
Okay, so let's break that down.
What was the farmer's value added? His output was 100, his input was 0, so 100 minus 0 equals 100.
Simple enough.
What was baker's value added? His output was 200, but his input, his intermediate consumption, was the 50 he paid for the wheat. So 200 minus 50 equals 150.
So the baker didn't create 200 rupees of value. He created 150 rupees of value by transforming the wheat.
Exactly. Now add the value added from each stage. Farmer's 100 plus the baker's 150 equals 250. That is the true GDP of this economy.
That makes so much sense. So GDP is basically the sum of the gross value added, or GVA, of all the firms in the economy.
Precisely. GVA equals the value of output minus the value of intermediate consumption.
Before we move to the next method, the source mentions something about inventory. What if the baker makes all that bread but only sells half of it? What happens to the unsold bread?
That's a great question and a crucial point. If goods are produced but not sold, they are added to the firm's inventory.
Okay.
In national income accounting, we treat this as if the firm bought the goods from itself. It's counted as investment, specifically, inventory investment.
So production counts towards GDP whether it's sold to a customer or just sits on a shelf.
Yes, because the value is created in that year. GDP measures production, not just sales. This is a common point where students get confused in PYQs. They see unsold and think uncounted.
But it is counted.
It is counted,
Yeah.
just as an addition to inventory stock.
Got it. Okay, on to method 2, the expenditure method. This is looking at who is buying all this stuff.
Right. Instead of looking at the factory floor, the production side, we're looking at the checkout counter. Who is spending money? In a modern economy, there are 4 main categories of spenders.
I know this formula. It's tattooed on the brain of every economics student. GDP equals C plus I plus G plus XM goal.
The holy equation of macroeconomics. Let's break it down thoroughly because the nuances here really matter for the UPSC mains exam.
Let's do it. C.
First, C is consumption expenditure. Officially, it's private final consumption expenditure. That's you and me buying food, haircuts, Netflix subscriptions. This is usually the biggest chunk of the economy. In India, it's roughly 55–60%.
Okay. Then we have I, investment.
This is officially called gross domestic capital formation. It includes a few things. Firms buying new machines and building factories. That's fixed investment, plus the construction of new houses by households and that change in inventory we just talked about.
And the source notes that I investment is the most unstable of all these variables. Why is that?
It's because it relies on business sentiments, or what Keynes famously called animal spirits.
Animal spirits.
Yeah. Consumption is relatively steady. People got to eat. They got to pay rent. But businesses can panic. If they think a recession is coming, they can slam the brakes on investment overnight. They cancel factory plans. They stop buying machines.
Yeah.
That sharp drop in I is usually what triggers or deepens a recession.
That makes perfect sense. Okay, then we have G, government spending.
Right. Government final consumption expenditure. This is the government acting as a consumer. It includes salaries paid to soldiers, judges, teachers in government schools, buying paper for bureaucracy, fuel for police cars.
What doesn't it include?
It does not include transfer payments like pensions or scholarships.
Why not? The government's still spending money.
It is, but no good or service is being produced in return for that pension payment. It's just a transfer of income. GDP measures production, so transfer payments are out.
A critical distinction there. And finally, the last part of the equation, XLM, net exports.
Exports minus imports. We add exports X because foreigners are buying our stuff that's demand for our domestic production. But we have to subtract imports M.
Okay, why do we subtract imports? I bought that new iPhone, I spent my money on it. Surely that's part of my C, my consumption.
You did, and it is part of your C. But that iPhone wasn't produced here. GDP measures domestic production. Since your consumption figure already includes the money you spent on the imported iPhone, we have to subtract it back out in the M part to ensure we're only counting what was made within our borders.
So if we didn't subtract M, we'd be taking credit for China's or another country's production in our GDP.
Exactly. It purifies the number to only reflect what was made here.
Okay, that clarifies the logic. So that's method 2, sum of all spending. Now, method 3, the income method.
This one looks at the bottom of our circular flow diagram. Where did all the money go? It went to the factors of production as their income.
So you just add up all the earnings.
You just add it all up. The formula is GDP, W plus R plus N plus PS here.
Wages plus rent plus interest plus profits.
Right. In the official statistics, they often group these a bit differently.
Okay.
First, you have compensation of employees. This includes wages, salaries, and any Social Security contributions made by employers on behalf of their workers.
That's the biggest chunk.
By far. Then you have operating surplus. This is basically the sum of rent, interest, and profit. It's the income earned by property and enterprise.
So what the business generates after paying its workers.
Exactly. And third, there's a special category called mixed income of self-employed. This is particularly important for a country like India.
Why is that?
Think of a small kirana store owner or a doctor running a clinic out of their home. They don't pay themselves a separate wage or rent for their shop. Their income is a mix of their labor, their capital, and their enterprise. So we just lump it all together and call it mixed income.
So the income method is compensation of employees plus operating surplus plus mixed income.
Correct. And theoretically, if the data is perfect, all three methods, product, expenditure, and income, must yield the exact same number.
Because one person's spending is another person's income, which is the result of what was produced.
That's a three-sided coin.
It's beautiful when the math works out, but of course in the real world, it's never that simple. We have taxes, we have depreciation, we have foreign income. This leads us to what I call the alphabet soup of national income.
Yes. GDP, GNP, NDP, NNP. It can get confusing, but honestly, it's just about making adjustments to refine what we're measuring. It's like applying different filters to a photo. You just need to know which filter does what.
Let's tackle the price categories first, because this is often where the tricky questions hide. Factor cost versus market prices.
Okay, let's stick with a car example. Imagine a car rolling off the assembly line at a factory. The cost to produce it, paying the workers, the rent for the factory, the interest on loans, and the profit for the owner. That sum is the factor cost.
It's the true cost to the factors of production.
It's what the producer actually receives and distributes. But that's not the price you pay at the showroom, is it?
Not even close.
No. Before you buy it, the government steps in. They add indirect taxes, like GST. But let's say it's an electric car, so maybe the government also gives a subsidy to lower the price and encourage its use.
So taxes get added, subsidies get subtracted.
Exactly. The formula is market price, factor cost, plus indirect taxes subsidies. And that term, indirect taxes subsidies, is often just called Net indirect taxes, NIT.
That's clear. Market price is what I pay at the counter. Factor cost is what the producer actually keeps to pay the factors. But the source material mentions a third category, basic prices. This seems to be a middle ground.
Yes, this is a more recent nuance that the CSO, our Central Statistics Office, uses. It distinguishes between two types of taxes: production taxes and product taxes.
What's the difference between a production tax and a product tax?
Production taxes are independent of the volume of production. Think about land revenue or stamp duty or a professional license fee. You pay these just for being in business, whether you make 1 car or 1,000.
But you pay it even if you produce nothing that year.
Right. Whereas product taxes are paid per unit, like GST or excise duty. You only pay the tax if you actually produce and sell a unit of the product.
Okay, so one is a fee for existing, the other is a fee for selling.
A great way to put it. So basic prices are the factor costs plus those production taxes, but not the product taxes.
Yeah, market prices.
Market prices are the basic prices plus the product taxes. So it includes both. Currently, in India, when we say GVA, we usually mean GVA at basic prices, but when we say GDP, we mean GDP at market prices.
Got it. A subtle distinction, but very important for the exam.
Mm-hmm.
Okay, next huge potential confusion. Domestic versus national, GDP versus GNP.
The difference is simple if you remember this. Where versus who.
Where versus who. Okay.
Domestic GDP is about where the production happens. It's everything produced within the geographical borders of India. It doesn't matter if an Indian company like Tata made it or if a Korean company like Hyundai made it. If the factory's on Indian soil, it counts towards India's GDP.
Okay, so GDP is about the territory.
Okay.
And national GNP.
National GNP is about who is doing the producing. It's everything produced by the normal residents or nationals of India, regardless of where they are in the world.
So if an Indian engineer works in Singapore and sends money back home,
that income adds to our GNP. Or if an Indian company like Reliance has a factory in Africa earning profits, those profits are part of India's GNP.
but we have to subtract what the foreigners earn here, right? Like that Hyundai factory in Chennai.
Exactly. The profits Hyundai makes in Chennai and sends back to Korea are subtracted from our GDP to get to our GNP.
Mm-hmm.
This adjustment is called net factor income from abroad, NFIA.
So the formula is?
GNP equals GDP plus NFIA.
Right.
And NFIA itself is the factor income earned by our residents for the rest of the world, minus the factor income paid to non-residents who are working here.
Usually for a developing country like India, is that NFIA figure positive or negative?
It has historically been negative for India.
Why is that?
We have a lot of foreign investment here taking profits out. We pay a lot of interest on foreign loans. Now, our remittances from Indian workers abroad are huge. India is the top recipient globally. But the net figure, when you account for corporate outflows and debt servicing, often ends up being negative.
Okay, last adjustment in the alphabet soup. Gross versus net.
This is the easiest one of all.
God.
Gross includes depreciation. It's the total investment. Net excludes depreciation. It's the true addition to our capital stock after accounting for wear and tear.
So NDP, net domestic product, GDP depreciation.
And NNP, net national product, YNP depreciation.
And NNP at factor cost. That is the holy grail. That is what we officially call national income, isn't it?
That is the one. That is considered the purest measure of the actual income available to the citizens of the country. It strips away the market-distorting taxes, factor cost. It includes only our national's income, national, and it accounts for the machinery wearing out.
But wait, that's still not the money that ends up in my pocket. There's more. We also have personal income and personal disposable income.
Yes. We're drilling down further. National income is what the country earns collectively, but personal income, PI, is what households actually receive.
What's the difference?
Think about it. Firms earn profit, which is part of national income, but they don't give it all to you as a shareholder. They have to pay corporate tax to the government.
Okay, so that's subtracted.
And they usually keep some as undistributed profits or retained earnings to reinvest in the business. You never see that money directly.
So I subtract those from national income too.
Yes. But, on the other hand, the government also gives you money that you didn't earn in the production sense. These are called transfer payments.
Things like pensions, scholarships, unemployment benefits.
Exactly. That money goes directly into your pocket, so it's added back in to calculate personal income.
And finally, disposable income. That sounds like what I have left to spend.
That's the bottom line. That's what you actually have left after you pay your personal taxes, like income tax, and any non-tax payments, like, say, a traffic fine.
So PDI, Personal income, personal taxes, fines.
That is the money you can actually use to buy that pizza we talked about at the very beginning. That's the money that truly drives demand in the economy.
Okay, we've crunched the numbers, we've filtered them, but there's a massive problem with measuring money over time. The price of things changes. 100 rupees today isn't what 100 rupees was in 1990.
This is the absolutely crucial difference between nominal GDP and real GDP.
Let's break it down. Nominal.
Nominal GDP is the value of production calculated at current prices, the prices that exist today. The problem is, if the price of all apples in the economy doubles, nominal GDP also doubles, even if we didn't grow a single extra apple.
That's a misleading signal. It looks like growth, but it's just inflation. It's an illusion of wealth.
It is. It's a money illusion. That's why economists, policymakers, everyone prefers real GDP. For real GDP, we value today's production using the prices from a fixed base year. We lock the prices in a time capsule.
What's the base year in India right now?
Currently, it's 2011-12, so we measure everything produced in 2024 using 2011-12 prices. This way, if real GDP rises, we know for a fact that the actual volume of production has risen, not just the prices. It's a true measure of growth.
And if we compare the two, nominal and real GDP, we get a measure of inflation, right?
Exactly. That gives us the GDP deflator.
The formula being?
GDP deflator, nominal GDP, real GDP by 100. It gives us a measure of how much the average price level has risen across the entire economy since the base year.
Now, how is that different from the CPI, the Consumer Price Index, or the WPI, the Wholesale Price Index that we always hear about in the news? This is a favorite question in the exams.
It's a very common trap. There are two key differences.
Okay.
First, the basket of goods. CPI only looks at a fixed basket of goods that consumers typically buy: food, fuel, rent, clothing. GDP deflator looks at everything produced domestically, including things consumers don't buy, like big machines, tanks, bridges.
And the second difference?
Imports. CPI includes imported goods in its basket because we as consumers buy imported oil and phones.
Right.
The GDP deflator excludes imports entirely because, as we said, GDP is about domestic production.
So if global oil prices spike, and since India imports most of its oil, the CPI will shoot up.
Yes, CPI will spike immediately, but the GDP deflator might not move as much because that imported oil isn't part of our domestic production. It's a critical distinction for our UPSC listeners. Imports affect CPI, not the deflator, at least not directly.
Got it. Now, we've done the math. Let's get to the philosophical part of the deep dive.
The so what question.
Exactly. We chase GDP growth like it's the holy grail. Politicians live and die by these numbers. But does a high GDP actually mean people are happy? Does it mean the country is doing well?
This is the section on GDP and welfare. And the short answer is no, not necessarily. GDP is a measure of production, not a measure of well-being. It's a scorecard of quantity, not quality.
Okay, so what are the specific limitations? What does it miss?
First and foremost, distribution. You can have a massive, soaring GDP, but if 90% of that new income goes to the top 1% of the population, the average person on the street might be poorer and more miserable than before.
So GDP is just an average. It hides inequality.
It completely hides it. There's the old joke. If a billionaire walks into a bar with 10 regular people, the average wealth of everyone in that bar suddenly shoots up to millions of dollars.
But the other 10 people didn't actually get any richer. They're still just buying a beer.
Exactly. GDP tells you the size of the economic pie, but it tells you absolutely nothing about how that pie is sliced.
Okay, what's the second big limitation?
Non-monetary exchanges. This is a huge one, especially for developing countries like India.
What does that mean?
It means any valuable activity where money doesn't change hands. The classic and most important example is women at home.
The work done in the household.
Domestic chores, cooking, cleaning, raising children, caring for the elderly. This is work that is almost entirely performed by women, and it's not paid. No money changes hands.
So it's not counted in the GDP?
It is completely invisible to the economy. But think about the incredible value. If you had to hire a maid, a cook, a nanny, and a nurse to do the exact same work, you'd be paying them tens of thousands of rupees every month. That would be counted in GDP.
So GDP massively underestimates the true value of work being done in our society.
Massively. It also ignores things like the barter system that still exists in some rural areas. I give you a bag of rice, you fix my shoes. No money, no GDP record, but value was definitely exchanged.
That's a huge blind spot. And the third limitation?
Externality.
Externalities.
An externality is when an economic activity affects others, but the price doesn't reflect that effect. The most obvious one is pollution, which is a negative externality. A factory produces chemicals. That production adds to GDP. But in the process, it dumps toxic waste into the river, killing the fish and making people downstream sick. The GDP counts the chemical production as a plus. It does not subtract the loss of the clean river or the health of the citizens.
In fact, if the government then has to spend money to clean the river,
That spending adds to GDP.
and if it builds a hospital to treat the sick people,
That also adds to GDP. It's the ultimate irony. We can get richer on paper by destroying our environment and then paying to fix the damage we caused.
it's a perverse incentive.
It is. This is why economists are now looking for alternatives like green GDP or the Human Development Index or even the Happiness Index.
Before we wrap up, we should connect this theory to some contemporary Indian context. The source material highlights two major economic events, demonetization and GST. How do they fit into this framework we've built?
They are perfect examples of how policy directly impacts the variables we've just discussed. Let's take demonetization in November 2016.
Right, the government invalidated the 500 and 1,000 notes overnight, 86% of the currency in circulation.
It was a massive shock to the system. In the short term, it caused a severe cash crunch. Since cash is the lubricant of the vast informal economy, transactions slowed down dramatically. You could argue it hurt the flow of income, at least temporarily.
But what was the long-term goal from a macro perspective?
The goal was to force money that was outside the system, black money, into the formal banking system.
To turn uncounted economic activity into counted taxable activity.
Exactly. The long-term goals were to increase the tax base, push for digitization of payments, and theoretically bring more of the real economy into the visible GDP calculation.
And what about GST, goods and services tax, rolled out in 2017?
One nation, one tax. Before GST, India had a complex mess of different indirect taxes.
Yeah.
Sales tax, VAT, excise, luxury tax, and so on. It was different in every state.
And you had the cascading effect.
The dreaded tax on tax. GST replaced almost all of them with a single unified system. It creates a single national market.
And how does it avoid that cascading effect?
Through the mechanism of input tax credit. Remember our value-added discussion with the farmer and the baker. GST essentially ensures you only pay tax on the value you add at your stage of production. You get a credit for the taxes already paid on your inputs.
So it lowers production costs and makes things more efficient.
That's the idea. It boosts the ease of doing business, makes supply chains more efficient.
Which, fingers crossed, should lead to higher real GDP growth in the long run.
That is the plan. Efficiency usually leads to growth.
So let's repack this whole thing.
Let's summarize.
We started with the invisible machine. We learned that macroeconomics looks at the whole forest, not the individual trees. We saw how money flows in a circle, from firms to households, and then right back again.
We learned that you can measure that flow at 3 different points. The factory gate, using the product method,
The checkout counter with the expenditure method.
or the pay stub with the income method.
We navigated the alphabet soup of GDP and GNP, NDP, and NNP, realizing that real numbers matter so much more than nominal ones because inflation can create an illusion of growth.
And finally, we humbled ourselves a bit by admitting that GDP isn't a perfect measure of human happiness. It misses the inequality distribution, it misses the damage from pollution, and it completely ignores the invaluable unpaid work of millions, especially women.
It's a tool, and like any tool, you have to know its strength and its limitations to use it properly.
Well said.
So here is a final provocative thought for you to mull over today. If we actually found a way to accurately monetize and count all the domestic work and the entire care economy in the GDP, how would the global economic ranking of nations change?
That's a fantastic question.
Would the traditional superpowers still be the superpowers? Or would societies with strong community and family structures, where a lot of this unpaid care work happens, suddenly shoot up the list?
That is a fascinating thought. It completely redefines what we consider productive. It questions the very definition of economic value itself.
Indeed. All right, friends, that's our deep dive for today.
We covered a lot of ground.
We did. And once again, please, if you found this useful, subscribe to Simplified UPSC by PPP. It's your support that allows us to do this kind of research.
And a massive thank you again to our Patreon supporters. You guys are the real MVP, most valuable patrons.
Yeah, absolutely.
Don't forget, the free notes and PYQs are waiting for you on the public Telegram channel. But if you want that organized premium experience, all the videos, detailed notes, model answers, you need to join the private Telegram library. Just DM us on the public channel to get in.
Like the video, leave a comment with your biggest takeaway, or maybe your answer to my provocative question about the care economy. I'd love to read your thoughts. Until next time, keep learning, keep questioning.
And keep diving deep.
See you next time.